Hi, Joseph. How are you doing?
Hey, Eli, I'm well. How are you?
I'm good. I'm good. How are you? Oh, my hair is doing some crazy things right now. Are you excited about Thanksgiving? Do you have any fun plans?
Yes, Thanksgiving is my favorite holiday. Part of the reason for that is my family and I play golf in the morning every Thanksgiving, like super early. So our
Okay.
tee time this year is at 7:40 a.m. So I have to wake up at like 5:30 a.m. to get to the course. And yeah, it's Bloody Marys on the golf course and family outing.
Oh, how fun. I
Yeah,
love that. What a fun tradition. So
yeah,
we'll definitely have lots of fun then.
for sure.
All right.
How about you? What's your Thanksgiving tradition?
So when I was younger, our Thanksgiving tradition was always to get together with my family that's in Chicago. And it would just be a whole bunch of cousins and relatives, and there's too many cooks in the kitchen. And every year my aunt would bake the most delicious pumpkin bread. That was always something that we did. We always had pumpkin pie, but we
Yeah.
also had a lot of pumpkin bread, which is really good. Actually, funny that Janet just jumped on the call because I was telling her about this pumpkin apple chocolate chip bread that my aunt makes that is phenomenal. And so, so I'm going to make that for Thanksgiving this year just to kind of keep the tradition of having like a pumpkin bread baked good alive. And so, definitely very excited. We're going to be staying in the Bay Area this year, though, so we won't be seeing them, unfortunately.
Hopefully they can, mail you some of this famous pumpkin bread. I want to try it.
I know. It's so good. Believe me, next time we do something in office, I'll be sure to make some.
Yeah, get the recipe.
I can't make any promises to be as good as hers, but I will do my best.
Yeah.
All right. So I think just for the sake of time, we can go ahead and get started. As I'm sure you all know, today's topic of discussion is going to be mortgage for real estate investors. And so what the investing landscape is looking like. And we've got wonderful Joseph here from LoanDesk, who's going to be talking through this topic for us today. So Joe, the floor is all yours.
Thanks, Ayla. Okay. Hi, everyone. I think I know most of you on the call. Thanks for joining. For those that don't know, my name is Joseph Flannery. I'm the head of mortgage at Radius. We run your LoanDesk, and wanted to basically share some of the programs that we put together for real estate investors. And I'm curious also if you have any stories to share of working with investors. I'm certainly curious to kind of get your thoughts on what the difference is working with an investor versus somebody who's buying as a primary residence. Raul, I see you're on the call. Are you in a place where you can tap into your microphone?
Yeah.
Okay, nice. Oh, there's Raul. So Raul and I have worked together for the last 6 years. Raul is one of the most knowledgeable loan officers that I know. He's been in the industry now. How long, Raul? 18 years?
Yeah, since 2004.
So long enough that you just stop keeping count.
Yeah, just a long time.
Yeah, a long time. All right, Raul, let's before I wanted to jump in, I want to just share this update to the special purpose program that Freddie Mac has. Basically, here, I'll kind of share my screen here. So very powerful for first-time home buyers. And the list of metropolitan statistical areas, basically the areas that qualify, was just recently updated. So essentially, to just kind of go through the program, it's a first-time home buyer program, okay, where the borrower can receive a $5,000 grant that can go towards the down payment or towards closing costs. And they get up to $500 towards the appraisal, $500 towards a home warranty. But the main thing is that $5K grant. And all they have to do is be located in an eligible census tract. There's no income requirement. There's no asset requirement, nothing. So this eligible census tract was just updated this week. Used to be only like 6 areas. It used to be like Georgia, be like, I think the ones at the top, like Georgia, Atlanta, Detroit, Philly, Chicago, and Memphis. Now it's all these areas too. So we have Texas, San Antonio is now part of it. Houston, Brownsville, Dallas, Fort Worth. So if you know any real estate agent that's in these areas, you really should now there's even a California county, Riverside, San Bernardino, Ontario is now eligible. All the client has to do is be living in one of these areas, and they are eligible. If it's a primary residence, first-time home buyer, they're eligible for this $5,000 grant. It's really, really easy. It can be a 97% loan to value, can do reduced PMI, all the other bells and whistles. So in my opinion, this is probably the most powerful first-time home buyer program because most of them have like income requirements, whereas this one does not. Like here we are, like Home Ready, you have 80% AMI requirements. There's no income requirement on this. So that was what I wanted to lead with. All right, let's do a quick. Jeanette, are you open to a Q&A? Like, have you ever worked with a client who's buying an investment property?
I have.
Okay, do you know what they're financing, how they went through financing to acquire the property? Was it all cash? And before we even get there, how is it emotionally, dealing with, an investor versus somebody who's buying a primary residence?
So emotionally, I feel like majority of the time, if they've been doing it for a while, they are disconnected. Most investors. If they are just starting out, they are usually totally worried about cost and well, if they're savvy enough, let's put it that way, because you have some that may make small mistakes, right? But they're worried about cost, and if they're usually using hard money, most of them don't have cash on hand, and it's something that they're getting into. If it's a seasoned investor, I literally have some that will, hey, give me an hour, let me look at the property and I'll let you know. And we can close a deal in like 7 to 10 days, depending on as soon as title or escrow can get it closed. But usually there's not a lot of emotion involved, and you can get the deals done fairly quickly. And, it makes good for everyone involved.
Yeah. Well, it's great to get your feedback. And from my experience, that's similar too, because it's all about the numbers. Because when someone's buying a home, there's so many factors that go into the purchase. Whereas the investment property, it's really like, hey, what's my potential return on investment, like any other asset? So then it's being compared maybe to, other assets. I could, with this money, I could, potentially buy bonds and rather than real estate, or I could buy stocks. So in my opinion, it makes it much more, numbers focused. At least a good investor, that's where they want to focus on, is just, what are the numbers, and as well as maybe what the opportunity is as far as improving the property. But what I wanted to share is what I have noticed in a trend just in my own business is actually working with California buyers who are purchasing investment properties. Let me silence my phone here. California buyers purchasing investment properties in other states. This is really the kind of like the growth area of my business in 2022 and in 2023. So whether that be Texas or Florida or Arizona. And so I want to just run through that. Rates are pretty low on a Fannie, just a traditional Fannie Mae investment property. So most people don't think of Fannie Mae when it comes to investment property. So just put investor. This is the UWM pricing calculator. So you can we're lifting the curtain as to, what we're pricing out with. Okay, it's a purchase. And we'll say 25% down, which is really kind of you can do 20%, and I can run the numbers here. Let's just say it's, we'll put California for now. And let's say it's a well-qualified borrower. And what's nice with Fannie Mae is you can use 75% of the anticipated rental income to offset the monthly mortgage payment. So the client really doesn't need to own the property. The client doesn't need to make a lot of income because you can use that 75% to offset. So let's just get a quote, see what today's rates are on an investment property. All right, so at 0 points, today's rates, you're looking at an 8.604% on a conventional 30-year fix. And if they wanted to buy down, let's say if you do 1 point, now you're at 7.99. You can buy down all the way to 2 points, now you're at 7.375. But at 0 points, you're basically at this 8.6. But potentially they would want to spend maybe $2,900 to get 7.99. So this is a 30-year fix. It's usually about 1% higher than a primary residence mortgage, but other than that, this is like, if the product fits this, then it's the way to go. And what I'm finding is a lot of buyers, they think they have to go hard money, but then when we run the numbers, like, no, you can just buy this on a Fannie Mae back loan, 30-year fix. You get locked in at that low rate. If rates fall, you can obviously refinance your mortgage, and you're now, you can use 75% of the anticipated rental income towards the payment. Raul, so this is now, if they cannot qualify for this program, and again, this is for more of a long-term, or for a buy and hold. It's not a fix and flip. There's because the property will have an appraisal, and so it has to be, as is. It can't be subject to repairs. And Raul, do you want to take maybe the next product? I wanted to go over the DSCR loan. Is that something that you can kind of shed light on? What is the DSCR loan?
So with the DSCR loan, it's meaning that, like, you're not qualifying on your income or your ability to repay the loan, but you're actually qualifying on the property's ability to repay the loan. We actually have a couple of different DSCR products with LoanDesk, which is cool, where we have products where, most people obviously want a cash flow when they have an investment property, and we have a DSCR loan where you have positive cash flow after all your expenses. But we also have DSCR products where you don't have positive cash flow. And, sometimes that is the case, right? In certain markets, we're here in California. This is one of those markets where sometimes you don't cash flow, but you're purchasing the property for future value, or in anticipation that rents eventually will go up and you'll eventually cash flow, or also sometimes as a write-off on your taxes. So there's different investment strategies there, but we have a couple different options when it comes to DSCR, and the most important thing to know about that particular loan is that you're qualifying on the income of the property.
Yeah, that's a great point. So basically, no tax returns required, no W-2s required, no pay stubs. Really easy loan to get through, and especially we work with a couple lenders that underwrite in 24 hours. So like this could, because it's you need the appraisal, you need the title documents, you obviously need the insurance, but like that's what's going to dictate the timeline of closing. The mortgage is basically underwritten already if the client has cash in hand, and assuming the borrower's the property is not in like a state of disrepair. So whenever like I'm going through when I'm talking with a client, usually they're not aware of all the loan programs. So my first thing is, okay, can we get it to work within Fannie Mae, Freddie Mac because the rate is going to be lower? No. Okay, can we get it to work under the DSCR program because now income is not an issue? Then you might have situations where you can't get either because the property is not up to snuff. And so we actually work with a few lenders that do fix and flip. So let me share screen here, and I'll just kind of walk you through. But
one thing I want to throw in there, this I've heard from Joseph a couple of times, where it's like if the borrower has 25% down, the client has that much money to put down, we'll find a loan for them.
That's right. That's right. And that's on primary residence. That's on investment properties. That's on vacation homes. If you have money for a down payment, there is a lender out there.
Yep.
All right. Let's go through a fix and flip. So we're buying a primary resident, an investment property, fix and flip. Let's just say it's a single family. We'll say California. Say excellent credit. And we'll just do very short turnaround. We'll do 18 months. Okay. Well, let's just see what happens when we do 12. Okay. And you want to do a purchase. Raul, give me a number. What's 800,000? Let's say you're buying that property. Okay. All right. So let's say the initial loan amount is, so you're putting 20% down, so that's 640. And then let's say the rehab cost is another 100,000, say 150,000. But after the rehab cost, it's going to create another 250,000. After the repair value, so then the total loan amount is 790. So you're borrowing based off the rehab and off the the total loan amount. So you can see here you can get a 12-month term. So you're looking at 12% rate. Not ideal, but if you're making 100K off the off the rehab, if it's a great property, like this potentially could work. And so the key is options. Like if you have a client that is looking to buy a property that needs that, and they're looking to fix and flip, like LoanDesk has these options available, and we can move very quickly. So actually, extending the term really doesn't change the rate that much. So it gives a little bit more time. Let me just see if we do 24. Yeah, so you can see it. And let's see what happens if the credit score goes up. I like to just kind of play around with numbers and see, what works. And obviously, if there was more equity, then I'm sure the rate would go down. Let's say if it's put this as a 500,000 initially. Yeah, so then the rate kind of decreases. So fix and flip is an opportunity to get into a property, fix it up, get the rehab cost. You got to have the initial capital to get into it. I think it's an 85% loan to value initially. But then after that, you're going to get, your client's going to get the rehab cover, the cost of the rehab covered.
Now, some people, especially if they're used to interest rates on, on owner occupied properties. They might see these rates as high. Even as a realtor, right? You'd be like, oh, shoot, this is a high rate. But another seasoned investors, they're used to these rates already. So, you might not have to explain too much to them. But on those few borrowers that you do have to explain it, um, they're not paying 12% like let's say they get 12%, right? They're only paying that per year, so like if they did the project in like 6 months or 10 months, they didn't pay 12%. They only pay interest for 6 to 12 months. These are annualized rates, so that's another thing to keep in mind as well, to kind of like, let clients know, like, hey, you're only paying this as long as you have this loan.
I like it. Any other investment property programs, Raul, that you can think of?
Well, we have a new product with a lender that's really interesting. I'm trying to get some marketing for it. Once I have it, I'll be able to shoot it out to our realtors. But basically, they call it a graduated loan. And what it is, it's pretty much a buy down. It's a buy down of the loan for the first 5 years, and you don't have to get any credit for it. So that's the cool part about it. It's not like, hey, we got to get this big seller credit to do this buy down. Obviously, it's an investor loan. You have to do 20 or 25% down, depending on people's credit. But if you're able to do that, then the buy down is really interesting. It's less than interest for the first 5 years. You could choose less than interest only, and then obviously it's going to be fully amortized for 5 years. But basically, you have a lower payment for the first 5 years. So you're, more than likely, the way rates are going right now, people are going to refinance within a year. Worst case scenario, within 2 years. So if you're buying down and having that lower payment for 5 years, then you have more than enough runway to refinance out of that rate. And you're getting today's rate. So that's the worst case scenario, right? If they did nothing, then they're going to get today's rate in 5 years.
Yeah, makes I didn't even know about this, so thank you for sharing. So
yeah, I just learned about it yesterday.
But honestly, like with an investment property, the first few years are the trickiest part, because like key. That's yeah. So if you
it's just getting in,
because then once you can start building equity in the property, and then at least after 5 years you refinance your mortgage, now you're extending the term again, and or you can put, pay more towards interest if you want to, but at least then your cash flow, then it has a better chance of cash flowing after 5 years.
Right, because a lot of investors, what they're finding right now, I've been on a lot of forums and different kind of things, and especially California investors, what they're finding is that they're having to put more money down in order to cash flow. Like I said, I mean, most investors here now, they realize, okay, we're breaking even. A lot of best case scenarios, and in average scenarios, people are actually negative, but they view it as a write off and future appreciation. So if they're putting a little bit more towards the deal, then they could cash flow, or they could get a product like this where the cash flowing right out of the gate, and then it's like, okay, well, we have 5 years to get a lower rate or pay down our mortgage, and then we'll continue cash flowing, once we do that.
Yeah, makes total sense. Because I imagine a savvy investor who's calculating the numbers right now and say, okay, I'm not cash flowing right now at 7.75. But if the rate were 5.75, I would be. And so rather than wait for the rates to get to that point, buy now. And let's say if this product, the graduated payments didn't exist, but you're in the red for first couple of years, and then whenever rates fall, your refinance. You're kind of baking it into the model.
And with the graduated payment program, what's cool about it is that they have a template that they were showing me yesterday, where the interest rate, if you were to compare it, it's like 6.5%. So basically the first 5 years you're getting 6.5%. That's what they're basing the payment off of, on interest only, as opposed to like doing 12%.
Cool. All right. Any questions for Raul or myself? Ewa, thanks for having us.
Both for joining us today. We do these rooms every Tuesday at 12:30. So we love having the team at LoanDesk join us for these lunchtime and learn room sessions. So, Janet, do you have a question?
No, I was just going to say thank you guys.
Thanks,
Jeanette. Thanks for joining.
Everyone has a wonderful Thanksgiving holiday and a great weekend. And we'll see you guys next time.
Awesome. All right. Bye. Thanks.
Have a good one.
Bye.